Hello everyone, this is Mark with Semantics Research with your daily report. So today we had a sell-off on the ES, failing to gain momentum above the previous overnight high. Taking a look at the sectors in the market, we had tech, financials, and consumer discretionaries leading in weakness, and this was due to concerns of the weak consumer confidence data, which exacerbated inflation and growth concerns. And despite having rebalancing towards the end of the month, which usually is against the sellers, the market sold off on economic fears, and we saw the treasury yields and the dollar moving higher as well. We are in a world of seeing many inflationary surprises, where data is surprising to the upside on economists' forecasts, and this is taking a heavy toll on the economy and financial markets. In response to this, the central banks have to raise interest rates and bond buying schemes. And as a result, we are seeing consumer confidence lower, much lower than the early days of the pandemic. And real-time indicators such as housing activity to manufacturing output is suggesting a very sharp slowdown in economic growth. We do have a reversal in the sharp increase of goods in last year, as the cost of shipping has lowered, but yet not to pre-pandemic levels. And many retailers have been spending big on inventory to make up for the lack of stock that was lacking in previous years. But now they have to sell at a discount as demand is currently dying. Car manufacturers also are picking up production, which lowers the price increases. But we are still seeing indicators of prices pointing upward still. For the near future, and we do have stubborn energy prices. So we do have inflation that is likely going to be stickier for some time. Yesterday, pending home sales surprised to the upside, showing that people are still buying up homes, and the durable goods purchases were above expectations, but the consumer inflation expectations also fell back a bit earlier this month, and what's very key is if we must look at PCE and consumer inflation expectations, and if they were to pull back, then you may see the Fed let off on the gas pedal a bit on the rate hikes in terms of how much we raise each time. And if we have disinflation showing, then there should be a slowing of how fast we raise rates, since it takes 6 to 9 months for the rate hikes to kick in. And yeah, we might be in a recession already also, and perhaps the market is thinking that this may be the case and now looking forward ahead. But we shall see. It is very critical for the Fed to reduce inflation, or else we may suffer a fate similar to the 1970s stagflation period. Because for a whole decade, core PCE inflation remained above 5%, and which was also was nearly 10% twice during that period. In addition, the real economy was very volatile due to distortion, which hampers real economic activity. And there were 3 recessions at that time as well. And it is likely that the Fed will have to induce a very deep recession in order to raise unemployment and destroy demand if PCE still shows that inflation is still strong. And if we take a look at oil, we saw that oil rose for a third day now as global output threats exacerbated already hot markets for physical supplies. And we also heard that G7 agreed to investigate a price cap for Russian crude. But instead of providing real solutions for crude oil prices, they're continuing to play political theater. And as long as the supply side remains constrained and demand keeps outpacing supply, we will likely see pressure to the upside on oil. Another thing to note is that producers have still not producers like in OPEC nations have not rebuilt the facilities to increase production like it was pre-pandemic. And also, we do see that green energy policies in the U.S. Discourage producers in the U.S. to expand their production. So as long as this is the case, we will continue to see pressure to the upside on oil. And for this week, we do have Powell speaking tomorrow, as well as a real, as well as a GDP number, and the Thursday PCE, which are also very key. And with that being said, I want to thank you all for watching. This is Mark with Semantics Research signing out. Thanks again.